Hi, after many years in property investment, I found that the three greatest and unnecessary mistakes that property investors make can be summarized by the three P's. They buy the wrong kind of property, they pay the wrong kind of price, and they buy it in the wrong place. And they often do a combination of all three. So I'm Neil Forster from Organic Growth. I'm a property investment coach and I'm a property investor, and I've been a property practitioner in Johannesburg for nearly 30 years. But enough about me. This short video, I want to have a look at the three mistakes in a little bit more detail. So firstly, property. What do I mean by the wrong kind of property? Because the options are so huge out there, from commercial property through to land. So the way to answer this question is best to just put a couple of factors down. When you're buying an investment property, you need to consider that you're focusing on getting future rental income growth. That's your objective. So the first thing you look at is this property rental income producing, and can I expect growth? Secondly, can I expect capital growth in the area? Thirdly, is it easy to maintain? And lastly, is it easy to manage? Because this is a 20-year project. The next P is price. We as investors, we have to recognize that you don't have to pay the full price. What kind of businessman stays in business by buying property, buying his stock at retail prices and trying to sell them at retail prices? So if you pay a lower price, it enables you to rent it out for slightly lower rental than the market. You secure a good tenant and so forth. So you can, when it comes to price, if you overpay when you buy the property, you can never get that back. You can't assume that one day you'll rent it out at a higher price or you'll sell it for a higher price to get it back. The old saying goes that you make your money when you buy. So when it comes to price, you as an investor, you're competing with Mr. Joe Public out there, who's just say he's just been transferred. He happens to have two children that are going to that specific school. His job is over there, and he's got a very small location wherein he can buy a property, and he's constrained by time and of course his budget. And at the end of the day, he ends up being forced to pay a full price. Whereas you as an investor, you can buy a one bedroom, a two bedroom, or a three bedroom place. You're not constrained by time. You can be buying in January, or you can be buying in December. You're not constrained there either, and you can be a lot more flexible with your location. So as an investor, if you're looking out there, there's a really good deal to be had any day of the week. And of course, you as an investor, you're not emotional about your investment. Your competition in the market, the people who drive the prices up, who pay the full prices, are the people who make the emotional decisions. They think, I'm going to live here, I'm going to sit here on the veranda and look at the view and so forth. So they'll pay a fuller price, and you don't need to pay that price. You just need to look at the property fundamentals. So the last of the three P's is the wrong place. Now, I'm going to mess with your mind a little bit here, because I think one of the bad areas to buy in is actually the best area. Now, by that I mean, let's consider Sandton. Now, physically, Sandton is over there, so forgive me if I glance out that way whenever I say the word Sandton. But if I had to go and buy a property in Sandton, I'm going to end up paying a full price because I'm competing with Joe Public out there who wants the prestige of saying I live in Sandton. And as a result, there's high capital growth in a place like Sandton, but your rentals are not commensurate with those prices. So you're going to find that your holding costs, your bond repayments, and your levies and so forth are high, and the rental income, although it's high, there's still a big gap. And that big gap means that you have to put more of your own cash in. And as any investor worth his salt will know, the more of your own cash you put into an investment, the lower your rental, returns on investment are. So the best area is not necessarily the best area to invest in. Then let's go across to the bad areas. Now let's pick on poor old Windsor and Hillbrow again. They're two northern suburbs of Johannesburg that you need to avoid as an investor. In those areas, when you do the cash flow, you're going to find that your holding costs, your bond repayments and levies are here, and your rental income is higher. So when you do the cash flow, it looks very attractive. You think, wow, I can buy this property, and from day one, it's not only paying for itself, it's going to give me a bit of profit. Well, the problem with that thinking is it's very short-term and short-sighted, and the rental that you were hoping to get the chances are you're going to have a lot of vacancy because of the area. You get a poor quality of tenant and be in a situation where you have to go and collect your rental from with a baseball bat. And I don't know about you, but that's not my game. And you find that over a period of time, your capital growth is very minimal, and your rental income is also growth is not that high either. And 10 to 15 years time, when you decide you've had enough of this thing, you want to sell it, you won't be able to sell your property for what you believe it's worth, and you're going to have to bring the price right down, and in so doing, you make it attractive for the next inexperienced investor. So my advice is don't go there in the first place. Then the third area that people buy in that's incorrect is a convenient area. And the best way I can explain this folly is with this painting that I've got behind me. So I want you to look at this painting and consider this to be a farm. There's the farmhouse, and this is a sort of rocky area right next to the farmhouse. But you can really keep an eye on this area. And I've seen so many investors say that, inexperienced investors say, I bought my first investment property down the road so I can keep an eye on it. It's on my way to work or something like that. And they're buying it because they think they can keep an eye on it. And this is like a farmer who goes and plants his crop in this area where he can keep an eye on it, when just down the road you've got this rich, fertile soil next to the river. I think it's very easy to see the folly of that decision from a farmer's point of view. But when it comes to property investment, I've seen this mistake being made over and over again. So in summary, your best area doesn't give you the best income returns, and the property is expensive, and your rentals don't match it. In the bad areas, you find your rentals are higher, your holding costs lower, but you don't get any growth. And then of course, when you buy in the convenient area, it's luck. You might just buy in a good area, but then again, you might not. And this is a 20-year plan, and you don't want to leave it down to luck. So my advice when it comes to buying a property is do your homework. Get some good coaching along the way. Now, the coaching can come in the form of a professional property coach like myself, or an investor friend who's actually invested in similar kind of properties in that area. Those kind of friends are invaluable. And remember that you're looking at a 20-year decision, and you can't take it lightly or leave it up to luck. I go into depth in these three issues: price, property, and place on 3 separate videos in the Organic Growth Investor Club resources page. So if you're an Investor Club member, go and have a look. I go into a lot more detail. That's all for now. Thank you very much for watching.